welcome to video 2. In this video we're going to go over we're going to go over smart money concepts and what exactly the difference is between smart money, institutional trading, ICT, etc., compared to retail trading, and why our system is a better system to trade. So retail, what they normally do is they're looking at trend lines. So once the market starts going up like this, as an example, they just mark up some trend lines. Normally they will say 2 points is enough to give you a trend line. So they'll have one hit, a second hit. Once market starts rallying, second hit, third hit, and it starts moving up. But then what happens is, boom, they get taken out. And so when you trade like this, what else will they do? They'll mark up support and resistance zones. So let's say this will probably be a support there, resistance there, and then when it's going to come back, their idea is, okay, it's going to sell off, but it just ends up crashing right through. Now obviously retail traders, they tweak their system and it works for them, which is fair enough, but we just prefer our own system of trading. So what we tend to do is the main thing that we're looking for when we're trading is a liquidity. Liquidity to us is the most important thing. So normally you have liquidity sitting above highs and below lows, right? Now one of the main things in what ICT teaches is equal highs and equal lows is where you're going to have a lot of liquidity sitting. So it doesn't have to be exactly equal, but this will be a high, this region right here, because there's 1, 2, 3 highs here where there's likely a lot of stop losses sitting. So market, as you can see, the market came up all the way up to there, above these highs, into a point of interest, a decision point at the high here, and then it started moving down and it dropped and broke structure. So now why would that be a interesting and a good point for us to pay attention to? A good point of interest is because one of the things you're looking for is liquidity, then you're looking for a point of structure. So liquidity is very important to us. Even as the market was making its way up here, it's obviously, we're still looking at the GBP USD example. It's been bearish for the good part of, let's have a look, it's bearish since forever, basically since 2007, my goodness. And it has had, look, if you have a look here, there's there's some bullish moves up, but generally speaking it's very bearish. And liquidity to us is kind of what moves the market, because large institutional traders who we're mainly looking to trade alongside, remember, we're not trading against these guys, we're trying to figure out where did they get into the market so we can copy them or kind of get into the market a little bit later alongside them. So what large institutional traders need to do is they need to move the market above or below some type of liquidity, and then they'll send it the other way. So if you have a look here, how many times did the market move above some liquidity and move the other way? So it did it kind of there, that move there, let's mark it up. So that move there, it moved above these points of liquidity and then came back down. This move here, this move there, that went above this point of liquidity here and then it moved down. But then the main one we're looking for is that last point there before the market moved down. So that move there, look how many those equal highs here. Which it took out, nice clean equal highs right there. And we zoom in a little, market just moves above those equal highs. The market moves just above and it breaks structure on the other side. This is your structure point here. That would be your structure point right there. The market breaks that structure. As the market rallies up, it comes back, breaks that structure point, and then we can kind of look to start selling once it starts moving up. Now we know we're sellers and we're looking for some type of move down, correction, some type of retracement, move down. So that's how we trade the market. Now also, if you have a look at this point here, what did this do? So now the market looks like on the daily is kind of gone bullish, and it moves right above these highs here, takes out all of these previous highs, it hits some type of point of interest there, and then once they move the market down, it moves all the way down. And now we're aware that the institutions came in here. The footprints of the institutions, they can't hide their footprints because they normally bring in a massive amount of liquidity, and it's difficult to hide that. You can always see it on the charts. So what did they do? They moved the market above highs, equal highs, where there's a lot of liquidity sitting. They took a whole bunch of liquidity, they took a whole bunch of stop losses. So that's going to be your stop hunt candle, or it's going to be your FU candle, your order block, the last buy before the sell, whatever you want to call it. I mean, there's a whole bunch of names for it. So that's going to be your stop hunt candle. And then the market broke structure on the other side. Now this setup is a perfect setup for us because we know, okay, the only way for the market to have moved above those highs, above all those highs, and then break structure to the other side is if a huge amount of money came into the market. And only if that large amount of money came in could the market have done this, regardless of this happened around the around March, which was the coronavirus, the lockdown, all the rest of it. But it doesn't matter, the market does this all the time. I mean, look what type of coronavirus was going on last year for the market to do things like this. Here's a move here, look, so highs there, there's highs there, the market moves, this was in 2016, market moves above, takes out all of this liquidity, and then crashes below. So there's some type of institutions that came into play, and once the price, look at this bullish price, it's bullish, but it's only making its way up to where the institutions got in, and then it's going to come back down again. So I mean, even that move you could have traded, but it just, because of the time frame, it took from 2016 all the way, it comes back 2018, 2 years. That's obviously because of the time frame. If you have a look, this happens on every single time frame. It'll happen on the 1 hour time frame, and you can catch these moves every single day. Even all the way down to the 1 minute time frame, this type of thing is happening. And so this move here moves the market down. Now what we're looking for is we're waiting for the market to come back and to come into some area of inefficiency, or they call it inefficiency, imbalance, whatever type of fair value gap, whatever type of phrase you might have heard. So according to ICT, these wicks would be, I think he calls them exhaustion blocks, or something along those lines. But really what we're looking at is in there, what point of we're looking at this whole region. What we're going to do is we're going to mark up where has price come up to rebalance and where hasn't it come up to, and then once we can see that, that's where we going to try and look for trades. So rebalances is basically these inefficiencies in price movement here. What you want is price needs to be it needs to be traded perfectly. So between these wicks, between that wick and that wick there, that means when price sold down, price came back up to fill in some of those orders, but it didn't manage to fill it all. What you want is for perfect balancing of price would look something like this. So you have price moves down, price moves up really quickly, it comes down and it touches that candle, meaning all the buys and all the sells have been efficiently filled, so it doesn't have to come back to refill anything here. So when you have a look here, when the market came back, it just moved right through. It moved right through it because it was efficiently filled. And it's only when the market comes down here to this imbalance over here between between these two wicks here, the market comes between these two wicks over here on this side, it closes off the imbalance right there, closes off the imbalance by touching that wick right there, and then it reacts a little bit. So it's closed off the imbalance, it's reacted, and then it's carrying on. So these points of interest of imbalances, they'll normally react all the time. They're always reacting, whether it's this reaction was not in line with structure, so structure had moved bearish, but it still gave you some type of a reaction. Let's see if we can figure out how much of a reaction. Well, this is the daily time frame, so you're looking at 126 pips, which is quite a decent amount, even if you're in a smaller time frame. Sorry, even if you're on a larger time frame, so it looks like a small reaction, but it's a decent sized reaction. Between these points, and so the market is always reacting off of these inefficiencies, so you need to pay attention. But obviously we don't trade off every inefficiency, we look for the right ones, and we'll go over that in the next video. So we've gone through imbalances, and we've gone through these stop hunt candles, or you might want to call them order blocks, as ICT does, or you might want to call them FU candles, they're referred to at times. And then you're looking for, you want to set your alert, you want to see where the imbalances are, and then you want to wait for structure to break on a lower time frame to take your trade. And ideally what you want is your point of interest is always going to be above some type of liquidity or below some type of liquidity. Never trade a point of interest if there's no liquidity. So this point of interest right here, there's a nice order block here, nice ICT order block right there. It's even I mean, it did do some stop hunts. Technically it moved up into that point of interest there. It moved above these equal highs here, and so technically according to ICT that would become a propulsion block. And let's see if it reacted from the high. Let's mark up the low of it as well. And so you see when the market makes its way up, it starts reacting. It's taking some of the orders, but it's not really breaking structure. You can see kind of we're on the daily. Let's go down to lower time frame. It comes back to another point of interest. It's refusing to break structure. So I mean, if you were on a lower time frame, like on the 1 minute or something, you might see some structure breaks here, take the trade, and you just, you probably just lose it. Fair enough. But it's not giving any solid breaker structure. So we will continue waiting for a higher time frame. We'll continue waiting for a higher point of interest. Now we're in these blue horizontal lines are the real structure point on the weekly time frame. So we're quite high up. We're in the premium range of the weekly, and we're looking for some type of inefficiency or some obvious point of interest for the market to go up to before it goes into a bearish before the market turns bearish, so we can take a sell. So now if we zoom in here, we've got a high, and then we've got inefficiency, we've got a fair value gap, or whatever you want to call that, inefficiency. So we can mark this up. So we're marking up the bottom of the wick on this one, and we're marking up the top of the wick on that one. So between that gap there, there's inefficiency, and then we're looking for this to be filled, and then for price to react above this inefficiency. Sometimes it'll just about come into the inefficiency and just turn around. So you want to set your alert just above just below that line, really, and then start waiting for lower time frame breaks of structure. So as you can see, the market fills that inefficiency, moves above it, and then you have the lower time frame breaks of structure. And then eventually, there you've got your 1 hour breaker structure. Gives you a retail kind of head and shoulders pattern there as well, where you could consider these things, but we don't really pay too much attention to that type of thing. So what you've got, just in summary now, before we move on to the next video, is we don't really pay attention to retail structure. We're mainly paying attention to where the obvious liquidity is going to be set. So it's going to be above equal highs, below equal lows. Those are the ideal places, but above highs and below lows. So I expect turtle soup patterns. I expect the market to take liquidity and move in the opposite direction. Even here, take liquidity and then break into the opposite direction, break the lows on the other side. And you want to pay attention to your obviously have in mind your market structure, your real structure points. Don't ever confuse those. And obviously now you have your points of interest, which are your order blocks or your supply and demand zones, or whatever name you'd like to give that. Your order blocks are going to your ideal order block. Your ideal supply and demand zone should be the one which has inefficiency. It needs to have inefficiency before. Don't even look to take a trade if there's no inefficiency, if there's no fair value gap in there. As ICT states that the best order blocks are the ones with the fair value gaps. So just make sure you have your inefficiency before you even attempt to take a trade. And then once we've got our zone marked up above there, let's so what I would do in this scenario is I've marked up my inefficiency here on this time frame. So I would put a trend line kind of over, you know, somewhere around there. Oops, not a trend line, horizontal line around there, and I would set an alert to it. I'd set an alert, I'd wait for price to reach, and obviously bear in mind this is the, you know, larger time frame, so price is going to take a little bit of time to get there. I would start looking at it, I would start looking at that point of interest once prices started to move up. It's moving up, so I'm kind of wondering, is it going to react over here somewhere, or is it going to react over there somewhere? Now why would I prefer it react over there? Because even though this move took liquidity from there and it moved down really strong, it didn't leave like these equal highs, or it didn't leave these highs behind. It just kind of moved all the way straight down, so it didn't really leave any you know, solid liquidity on this side of the market. But once it started moving up, you do have some liquidity forming here, so you know, there's nice equal highs there. You can kind of clearly see right there, it sets equal highs right there, because there's no liquidity on this side really for it to take, because obviously once that market moved down that strongly, there's obviously not many buyers in there. There's institutions just maybe waiting for price to come back up, but there's no buyers. So you know, they're looking, sorry, there's no opposite side of the market. There's not going to be any stop losses or whatever, so they need to engineer liquidity, and that's where these equal highs come in. As the market's on the way up and it's giving you a higher low, higher high, another higher low, and it kind of gives you an equal point there, equal high. So what would happen is, what happens here, the market moves down, and so when retail traders are looking at this, what they're looking at is this as being a breaker structure, because it very obviously is a breaker structure. It is a clear breaker structure on the 4-hour time frame. So what we're paying attention to is equal highs, and we know equal highs are going to get taken out, and we're not going to bother taking a trade from here unless we're going to, personally, I might have even taken a trade around here somewhere, but I'd be looking to get out before price makes it back to these equal highs. So as you can see, retail traders are probably going to sell here, breakout traders or whatever, they're going to end up selling up here, and you see that little reaction, you see a little reaction until, you know, boom, it just takes them all out and it carries on moving up. So once price is making it back over here, you know, we've got like an order block zone here. We can probably tweak it a little bit and say on the daily you've got a nice clear order block, but the reason I'm not looking at this, and you know, I might have got duped a little, I might have taken this trade, but the reason I prefer the higher one, because that one is still in between these real structure points on the weekly time frame. The reason I'm looking at the higher one is because there's a whole bunch of liquidity set up there. There's equal highs, equal highs, equal highs. This rally is just, it's just all the way down, straight down, and you know, it's not giving me much to work with. So this liquidity on this side, this whole engineering of liquidity, this taking of liquidity on this side, this taking of liquidity on that side, this whole thing, this whole engineering of liquidity over here was purely just to push the market up to its actual point where it needs to go. It's just to push the market up above, you know, above these highs into an obvious point where the market will start to move bearish again. So they're trying to mitigate their orders. Big institutions have got into the trade here, quite obviously. They've moved the market to the other side. They need to bring the market all the way back, and they need to close out their buy orders so they can sell the market off again. And so if we start zooming in, can see between these white lines, we can see our inefficiency in price action. So I set my alert on that green line that I just put there, and I wait for price to make it up there. When price finally decides to trigger me in, I can when price finally decides to give me my alert, I can close my alert, I can remove it, and I can start paying attention to the lower time frames as price is approaching over here. So I'm going to go down to, let's say, the 5 minute, even the 1 minute, you know, ideally the 1 minute. I'm looking for something nice and clean, some breaker structure. I've already figured out there's liquidity on the other side, etc. That's my point of structure right here. I'm looking for that to be nice and cleanly broken. So even as price is approaching, even over here, if price was going to make up to their break structure, wherever price decides to break structure, if you have a look at price, it, you know, once it makes its way up to a logical higher time frame point of interest, then we go down to the lower time frame on the 1 minute and we look for a breaker structure. So this is my logical point, and once it comes down and break structure right there, now I can start looking for a sell. Now I'm looking for inefficiencies, or I'm looking for where price may react. And again, ideally I want my what I want is, again, I want price to move up above some type of liquidity and then move in the opposite direction, break structure in the opposite direction. And so ideally I'd love for price to make it all the way up here, because we've got equal highs that need to be taken out, and then we've got a little bit of inefficiency right there. Let's mark it up. So even if it's like 1 pip or half a pip of inefficiency, the market still needs to come back to take out that inefficiency and to rebalance the market. It's always going to do it. Now we need it to happen when it's in line with structure. So ideally I'd love the market to come up here so I can get triggered in on a trade up here, which would be, you know, I'd take the trade, let's say there, and I would have a 5, maybe a 6 pip stop loss. I'd put it 1 pip above the high, but if it chooses not to, fair enough. You know, what's this move here? It might still come up to this later on, so I might even put a pending order right there and just leave it. Let's see if the market triggers. Obviously I need to pay attention and not be silly and put a massive risk in there, 1% into that trade and nothing more, and then we can just keep tracking the market and just, okay, now we have a look. Now look what happened. The market didn't make it up to my ideal place, but it did move up. It took liquidity there, it came back down, and it broke structure again. Now I see some 2 or 3 points. I see 1 point over there, point of interest, where the market might come back to. I see another point of interest here. So these are 2 logical places I might be looking to take a trade. Why? Because there's inefficiency or fair value gap or imbalance, whatever you want to call it, and we're looking for the market to come back, fill that, and give us a trade, and you see it just keeps breaking structure. It will probably come back at some point. I just crashed my computer. So you see now, what did the market just do? It came, filled the inefficiency, and I could have had a trade there. I would have had it just after this inefficiency was filled, so right there. What? Would have had my stop loss just, what's the price there? I would have had it 1 pip above, so 59, right about there. 5 pip stop loss, and I'd ideally want to take out those lows, and let's see if it plays out. I mean, at the moment you're at a risk to if that plays out, it's like a 9-to-1 risk to reward, and you're in profit already, and the structure has broken right there. If I was in this trade personally, because of that structure break, I would put it to break even. This is just an example. I've not even had a look at this properly, but it was just an obvious one. Let's see if it plays out perfectly. Come on, pal. And there you are. It's your successful trade, 9-to-1. So it's really not that difficult. It's obvious, but in the next video we'll go through a few more examples, and I'll explain this strategy a little more. Thank you for listening.